about the discretionary financing need. Are we going to need to borrow money or sell stock next year to finance our company? And I like to think of it as checking the refrigerator. So let's say you're going to have a dinner party tomorrow night and you open up your refrigerator door and you discover a lot of food. You go, well, we'll be just fine. I don't have to go to the grocery store. But what if instead you open it up and you really don't have enough food for the dinner party? Then you've got to make plans. So discretionary financing need is just a first cut at, do we think we're going to need to borrow money or issue stock next year? It's just a rough and ready estimate. So the logic behind the discretionary financing need model is that there's a certain relationship between the size of our company and the assets and the current liabilities that'll be on our balance sheet. So if you had one store in one year and then the next year you open another store, you probably have twice as much cash in your company because now you have to have cash in two different stores. So the same logic applies to a bigger company. As it grows, it's just naturally going to have more cash on hand. It's naturally going to have more accounts receivable out there. It's going to need more inventory. So let's predict what the balance sheet's going to look like. And if we need more money, we need more capital on the right-hand side of the balance sheet to make that balance sheet balance, then we know we're going to have to issue some new debt or maybe sell some new stock. So the challenge is that finance textbooks often make this seem more complicated than it is by throwing a lot of formulas at it. So let's try to do an example without too many formulas. Let's assume that we have existing sales this year of 5 million and that they're going to increase by 10%. So that means next year's sales are going to be 5,500,000. Let's assume that our net income is going to be 10% of those sales. Let's assume on the asset side that cash is going to be about 5% of sales. Accounts receivable at any moment in time is going to be about 10% of sales, and inventory is going to be about 15% of sales. On the current liability side of the balance sheet, let's assume that accounts payable at any moment in time will be about 15% of sales, and that accrued expenses, utilities payable, things like that, are going to be about 5% of sales. Let's assume that the company's retained earnings at the beginning of the next year will be $100,000, and that will retain 50% of our net income. In other words, we'll pay out 50% in the form of dividends, and we'll keep 50% as retained earnings. So if next year's sales are going to be $5,500,000, and we guess that cash at any moment in time will be 5% of that, 5% of 5,500,000 is 275. Accounts receivable, 10% of those sales is 550, and inventory is 825,000. Let's presume that a 10% sales increase doesn't mean we have to open up a new plant, doesn't mean we have to get any new warehouses, open any new stores. If it did, we'd have to increase this number on the left-hand side of the balance sheet. So after all those assumptions, we add all this up and we have $3,650,000 on the left-hand side of the balance sheet. Next, we look at the right-hand side of the balance sheet. If accounts payable are going to be 15% of sales, that'll be $825,000. Accrued expenses, utilities payable, salaries and wages payable, that'll be about 5%. We've got our existing long-term notes payable up there. Now what's going to happen to retained earnings? Retained earnings at the beginning plus net income minus dividends is going to give us retained earnings at the end. So why don't you pause this video and see if you can figure out what the balance in the retained earnings account should be at the end of next year based on these assumptions. I hope you got it. If our sales were $5,500,000 next year and 10% of that is net income, that means we have $550,000 in net income. The facts tell us that we retain 50% of that, so $275,000 plus the $100,000 beginning balance in the retained earnings account means that our retained earnings would be $375,000 at the end of next year. So we add all that up and we get $2,650,000. In other words, our spontaneous financing from the natural growth in accounts payable and accrued expenses and our financing from our retained earnings, money that we make and we don't pay out, is not going to be quite enough to cover our expansion next year, so we're going to have to borrow another $1 million. Or maybe we issue stock for $1 million. Whatever it is, rough and ready, we think we're going to have to add another $1 million to the right-hand side of the balance sheet. So now that we've opened the refrigerator and see that we're going to be short, we can make a plan because we want to know when we're going to run short of cash, when we're going to need that extra debt or extra equity so that we can start planning for it right away.
So that's all there is to the discretionary financing need. We make a prediction about what our balance sheet is going to look like at the end of next year. If the right-hand side is predicted to be larger than the left-hand side, we won't have to go to the market. We won't have to issue new bonds. We won't have to issue new stock. On the other hand, if we look at the right-hand side and it's less than the left-hand side, we're probably going to have to go to the market. We're probably going to have to issue new bonds or issue new stock.